Hey, welcome back. If you have money sitting in a savings account right now, this video could genuinely change how you think about where you keep your cash. Today I'm going to walk you through exactly what Treasury bills are, why they're outperforming most savings accounts in 2026, how you can actually buy them, what the risks look like, and whether they're actually right for your situation. Stick around, because by the end of this video you're going to have a clear picture of an option that most everyday people completely overlook. Let's get into it. So let's start at the very beginning, because I know Treasury bill sounds like something only finance bros in suits talk about. But it's actually one of the simplest investments on the planet. A Treasury bill, or T-bill, is basically a short-term loan you give to the United States government. The government borrows your money for a set period of time, usually anywhere from 4 weeks to 1 year. And when that time is up, they pay you back with interest. That's it. You're lending money to the U.S. government, and they're paying you for it. Now here's what makes T-bills a little different from a regular bond. You don't receive monthly interest payments. Instead, you buy the T-bill at a slight discount, and then when it matures, you get the full face value back. The difference between what you paid and what you received, that's your profit. For example, you might buy a T-bill for $980, and 26 weeks later, the government gives you back $1,000. That $20 difference is your return. These have been around since the 1800s, and they've never once defaulted, not once. Which means when people say this is a safe investment, they're not just saying it. History backs it up completely. So now you're probably wondering, okay, but how does this actually compare to what my savings account is paying me right now? The answer might surprise you. Let's talk real numbers, because this is where things get interesting. In 2026, the average traditional savings account at a big bank is still paying somewhere around 0.4 to 0.6% annually. Yes, you heard that right. Less than 1%. Meanwhile, high-yield savings accounts through online banks are offering somewhere between 4 and 5%, depending on the platform and current rate environment. Now here's where T-bills come in. As of early 2026, short-term Treasury bills are yielding roughly 4.5 to 5.2% annually, depending on the term length you choose. The 6-month and 1-year T-bills tend to sit at the higher end of that range. So compared to traditional savings accounts, T-bills aren't just slightly better, they're massively better. And even compared to high-yield savings accounts, T-bills are either matching them or beating them, depending on the week. But here's the kicker that almost nobody talks about. The interest you earn from T-bills is exempt from state and local income taxes. So if you live in a state with a high income tax rate, places like California, New York, or New Jersey, your effective return from T-bills is actually even higher than the advertised rate when you do the math. A high-yield savings account doesn't give you that tax advantage, which means the real comparison is even more in favor of T-bills than the headline numbers suggest. So how do you actually get your hands on these things? That's exactly what we're covering next. Buying T-bills is way easier than people assume. There are really 2 main ways to do it. The first and most direct method is through a website called treasurydirect.gov. This is the official U.S. government platform. You create a free account, link your bank account, and you can buy T-bills directly from the government with no fees whatsoever. You can start with as little as $100, and the process takes about 10 minutes to set up. When you buy through Treasury Direct, you participate in what's called a non-competitive auction. That basically means you agree to accept whatever interest rate the market sets, and you're guaranteed to get the T-bill you want. New auctions happen every week for different term lengths, so there's always an opportunity to buy. The second method is through a brokerage account. If you already have an account with Fidelity, Charles Schwab, or Vanguard, you can buy T-bills right from your existing dashboard. This is actually more convenient for a lot of people, because it keeps everything in one place. You can also set up automatic reinvestment, so when one T-bill matures, the money automatically rolls into a new one without you having to do anything. One thing to keep in mind, when you buy through a brokerage, some platforms charge a small fee, but most of the major ones do not for T-bills specifically. Now, all of this sounds great so far, but I'd be doing you a disservice if I didn't walk you through the downsides too. Because yes, there are some trade-offs you need to know about. Alright, let's be honest here, because no investment is perfect and T-bills are no exception. The biggest trade-off is liquidity. When your money is in a savings account, you can pull it out any day you want. T-bills have a fixed term. If you buy a 6-month T-bill, your money is technically locked up for 6 months. Now, you can sell T-bills on the secondary market before they mature. but depending on market conditions, you might get slightly less than you paid. So if you think you might need the cash urgently, a shorter-term T-bill, like the 4-week or 8-week version, gives you more flexibility. The second thing to consider is interest rate risk. T-bills lock in a rate at the time you buy them. If interest rates go up after you purchase, you're stuck at the lower rate until your T-bill matures. On the flip side, if rates drop, you're locked in at the higher rate, which actually works in your favor. Third, T-bills are not FDIC insured. But before that freaks you out, FDIC insurance protects you if a bank fails. T-bills don't need that protection because they're backed directly by the U.S. government, which is actually considered a stronger guarantee than bank insurance. And finally, T-bills won't beat inflation during certain market conditions. They're not a growth investment. They're a cash management tool. You're not trying to get rich with T-bills. You're trying to make sure your idle money works harder than it does in a basic savings account. So who should actually be using T-bills? That's the final piece, and it's the most important one. T-bills are not for everyone in every situation, but they're probably right for more people than you'd think. If you have an emergency fund sitting in a basic savings account, moving it into a ladder of short-term T-bills, meaning you buy different ones that mature at different times, could earn you significantly more interest without taking on any meaningful extra risk. If you're saving for a goal that's 6 to 12 months away, like a vacation, a down payment, or a big purchase, T-bills give you a predictable return and a clear end date. That's actually ideal for this kind of goal. If you're retired or close to retirement, and you just want your cash to be safe and earn something reasonable, T-bills are one of the most time-tested options available anywhere in the financial world. And if you're in a high-tax state, the state tax exemption alone might make T-bills the clear winner over every savings account option you're currently considering. The bottom line is this: Treasury bills have been hiding in plain sight for over 200 years. They're simple, they're safe, they're backed by the most powerful government on earth. And right now, in 2026, they're quietly outpacing most of what the banking system is offering everyday savers. If this opened your eyes to something new, do me a favor and hit that like button. It genuinely helps this channel reach more people who need to hear this. Subscribe if you want more straightforward money content like this every week. And drop a comment below telling me, are you currently using T-bills, or is this the first time you're hearing about them? I read every single comment. See you on the next one.